The concentration trap. When revenue becomes risk. January is when a lot of owners quietly take stock. The business looks strong. Revenue is solid. Margins are healthy. And on paper, everything feels good. But there's usually one number owners avoid looking at too closely. How much of your revenue comes from your top 5 customers? From the inside, concentration doesn't feel like a problem. Big customers feel like validation. They're stable. They pay on time. You know them well. From a buyer's perspective, it's something very different. It's risk. And risk is always priced in. Here's where owners and buyers see the world differently. Owners look at customer concentration and think about history. How long the relationship has lasted. How much trust exists. How unlikely it feels like things will change. They're asking whether the business survives if incentives shift. That difference in perspective is why concentration quietly reduces valuation, even in strong businesses. Why concentration feels safe. Most owner-led businesses grow through focus. You land a few great customers early. You serve them well. They expand. They refer you. Over time, they become a meaningful percentage of revenue. From your seat, that feels earned, logical, even smart. But buyers don't evaluate businesses based on how they grew. They evaluate them based on how exposed they are after the sale. And concentration introduces one uncomfortable question. What happens if one of these customers leave after ownership changes? If losing a single customer materially impacts cash flow, growth plans, or debt service, buyers don't see upside. They see fragility. And fragility directly affects valuation. How buyers actually analyze concentration. Buyers don't ask, are these customers good? They ask, how exposed am I? During diligence, concentration shows up very mechanically. What percentage of revenue comes from the top 1, 3, 5, and 10 customers? How long have those customers been with the business? Who owns the relationship? The company or the owner? What happens to EBITDA if one leaves? Have any contracts changed hands before? How price sensitive are these customers? This isn't theoretical. In many deals, customer concentration is one of the first reasons multiples get reduced, often quietly without debate. Buyers aren't pessimistic. They're underwriting scenarios owners haven't had to face yet. And this leads to one of the most frustrating parts of concentration for owners, the invisible discount. You almost never hear, we're reducing the multiple because of customer concentration. Instead, it shows up indirectly. We need to be conservative. We're underwriting risk. We're adjusting for customer exposure. We'll revisit valuation after diligence. The discount happens anyway. 2 businesses can have identical revenue and margins. The one with diversified customers almost always commands a higher multiple, not because it performs better, but because it survives more scenarios. And buyers pay for survivability. This is where owners misunderstand the real issue. Concentration versus dependency. Concentration alone isn't always fatal. The real problem is dependency. Buyers get nervous when a single customer represents more than about 15 to 20% of revenue, or when the top 5 represent 40 to 60% or more, especially when relationships are personal to the owner. At that point, revenue starts to look less like an asset and more like a fragile arrangement. Pricing power lives with the customer. Expansion depends on goodwill. Contracts don't fully protect the downside. That's when buyers start pricing in risk aggressively. So what does healthy concentration actually look like to buyers? There's no single magic number, but buyers generally feel more comfortable when no single customer exceeds roughly 10 to 15% of revenue. The top 5 are under 30 to 35%. Contracts are transferable and enforceable. Relationships are multi-threaded across the organization. Customers are expanding based on value, not favors. The further you drift from this, the more risk buyers price in. Customer concentration isn't something you fix overnight. De-risking it De-risking it usually takes 12 to 36 months of deliberate work. That's why January matters. This is when owners still have time to act intentionally before buyers define the narrative for them. Most owners don't lose value because their business isn't good. They lose value because risk shows up where they didn't expect it. From the outside, it often looks weak. Seeing the difference early is how owners protect their multiple instead of explaining it anyway. If you own a business, follow along.